Okay, hi there. Welcome to a revision video where we're going to explore for a few minutes the extent to which profits and economic efficiency are linked. These are two really key concepts to get a hold of for your year 13 economics. So analysing the possible links between economic efficiency and the level of business profitability is often the focus of an exam question, both analysis and evaluation. So we're going to show quite a few analysis diagrams in this quick video, but also I think bring in some evaluation, in particular the extent to which other factors, both internal and external, impact on business profits, not just the efficiency of a particular business in a given market. So just a quick recap for revision for the main types of economic efficiency. Allocative efficiency is making best use of scarce resources at a price, making products that consumers need and want, but being sold at a price which reflects the marginal costs of supply. Allocative efficiency, where price equals marginal cost. Dynamic efficiency happens over time, and it refers to changes in the choices available in the market together with the quality of the performance of the products we buy, often including, for example, aspects of environmental efficiency. And the key issue about innovation in markets is what we associate with dynamic efficiency. Productive efficiency is all to do with the unit cost of supply. What can we get in terms of output per input? And so we reach productive efficiency when we've achieved an output at the lowest feasible average cost. In particular, in the long run, where firms get to the low point of their long run average cost curve, they achieve economies of scale and reach the minimum efficient scale. And we're also going to take a little moment to think about X-inefficiency. This can impact on profits. X-inefficiency can happen when the lack of genuine day-to-day competition in markets, a lack of real competition, may give a monopolist or duopolist a very weak incentive to invest in new ideas or consider consumer welfare. When we see X-inefficiency happen, often average costs drift higher. Firms and their managers can slacken their efficiency, and that can lead to higher unit costs. Okay, so let's look at what is your market structures and think about some of these questions. So first of all, to what extent are high monopoly profits, supernormal profits, the result of economic inefficiency? Well, let's take an example of a monopoly that has a fairly inelastic demand curve, a coefficient of elasticity over most of that length of less than 1. Superimpose some cost curves here, and a profit maximizing monopolist will choose an output Q1, charge a price P1, price well above cost there. There's the average cost AC1, and they can make a high level of monopoly profits as shown by the shaded area. So this is a good analysis diagram showing the monopoly profits earned by firms that can have price setting power. And of course, when demand is inelastic, they can charge a high price relative to cost. Now, crucially, from our efficiency point of view, the monopoly price, P1, is well above marginal cost as well as average cost. The price that's being charged is well above the marginal cost, leading to a loss of allocative efficiency and a loss of economic welfare. Now, the conventional argument against market power is that monopolists can earn supernormal monopoly profits in the long run. Of course, they can use barriers to entry at the expense of efficiency and the welfare of consumers and society as a whole. So a monopoly diagram lends weight to the argument that high profits are associated with economic inefficiency. However, of course, the opposite of pure monopoly is perfect competition. So what do long-run profits in perfect competition tell us about efficiency? Well, let's quickly recap what happens. Here's the short-run dynamic in the market for a perfectly competitive firm, where the market price P1, taken of course by all firms in the industry, is above cost, and the firm on the right-hand side there can make some super normal profits in the short run. But of course, in the long run, we're assuming that the market has no barriers to entry, and so the entry of new suppliers into the market shifts the market supply from S1 to S2 on the left-hand side there. That drives the market price down to P2, and you reach an equilibrium in the market where the price P2 is just sufficient to earn normal profit for each firm in the market. And in terms of economic efficiency, that is the long-run equilibrium price, P2. Well, it's allocatively efficient, if we go back to our diagram again, because the price that's being charged equals the marginal cost of supply. P2 meets marginal cost at Q2. It's also productively efficient, because if you go back to that price, that output Q2 is at the minimum point of the average cost curve. So the perfectly competitive equilibrium gives low normal profits, but achieves static efficiency, allocative efficiency, price equals marginal cost, productive efficiency, output is at minimum unit cost. So that is an equilibrium which is productively and allocatively efficient, although you could question whether it's dynamically efficient. The assumption of homogeneous products, standardized products, the same goods and services, implies there's little scope for innovation, which might lead to product differentiation. And of course, no one firm has enough profit to really invest heavily in research and development. How can economies of scale, in other words, gains in long-run productive efficiency, how can they cause an increase in profits? So what's the link between productive efficiency and profits? Well, economies of scale, of course, are hugely important. I'm sure you've covered them as part of your revision. You think about retailers such as Amazon and parcel companies and what have you, that can achieve huge economies of scale. It's very clear that businesses can harness big economies of scale in many fast-changing markets and industries, ranging from Amazon all the way through to the growth of the global beer industry, including my own favourite, BrewDog. Well, with economies of scale, of course, you're moving down the long-run unit or average cost curve. And minimum efficient scale is an important concept here. Minimum efficient scale is when long-run average cost is minimised. You've reached the lowest point on the long-run average cost curve, and that is the output of long-run productive efficiency. So what does this mean for profits? Well, effectively, as you can go back a slide here, as you move down that curve, you're moving on to lower sets of cost curves. So here is an initial set of cost curves, let's say with a medium-sized factory and plant. You can profit maximise an output Q1 and make a profit of the shown in the green area. Of course, if you can achieve substantial economies of scale, what's going to happen to our cost curves? They will shift downwards and to the right. We're moving down the long and average cost curve to a set of costs which are much lower. And even with a given level of demand, AR, the profit maximizing price and output changes. Output goes up to Q2 here, price falls to P2. Now notice here that although the firm is charging a lower price, P2, of course they've got a much lower unit cost. So the profit, the maximum profit and output Q2 and price P2 is much bigger, shown by the yellow shaded area there. So economies of scale, in other words, gains in productive efficiency, can lead to higher total profits. And also potentially get on consumer welfare. You might want to think in this diagram, for example, about the impact of this on consumer surplus. What about X-inefficiency? How can X-inefficiency impact on the profits achieved by a business? Well, X-inefficiency, first mentioned, I think, by Liebenstein in 1966, is a term we use when analysing costs in monopoly, duopoly, oligopoly. And it basically is the idea that when there's a lack of day-to-day effective competition, the average cost of production tend to be higher than they would be if the market was more competitive, more contestable. So X-inefficiency, it's often associated with managerial slack and high expense accounts and relatively low productivity. Firms that lack that intensity of competition often operate a little bit less efficiently than they should, and that leads to a high unit cost. And the way to show this is that if we go back to a long run average cost curve, for a given output Q1, instead of unit cost C1, if there's productive slack or X inefficiency, wasteful extra cost, the average cost tends to be higher. Now, I'm not going to show the impact of profit in this diagram, but you might want to consider the impact on profits and the returns for shareholders if there's X inefficiency. If you've got a level of cost that's higher than it should be, it's clearly going to hit profits pretty quickly. I mentioned that efficiency and profits are linked, but there are many factors external, not linked directly to efficiency, which can impact on business profits. And here are four of them. First of all, there's often unexpected events, external shocks that can affect profitability. We've seen in the last year or two the impact of the pandemic and lockdowns and restrictions on the profits of travel and tourism and hospitality and many other related industries. Industries and businesses get hit by environmental effects such as drought and flood and what have you. The impact of global terrorism can also impact on profitability of businesses. Most of these external events are beyond the control of the firm's management. And then we think about the impact of government intervention. Indirect taxes can affect profitability, such as VAT or carbon taxes or the sugar tax. Direct taxes affect the disposable incomes of consumers and their purchasing power and their spending. And government spending can also affect profitability, in particular during the pandemic, of course. The government financial support, including the furlough scheme, made available to tens of thousands of businesses in the UK. Profits can be affected by changing consumer tastes and preferences that are independent of efficiency. And many industries are regulated. Energy would be a good example here, where the impact of the energy price cap has damaged the profitability of many firms, indeed led to the exit of many smaller energy firms in 2021. And liberalisation of the market, which opens markets up, encourages new entrants and brings down supernormal profits independent of the efficiency of the business. So, rounding up, in theory, profits and efficiency can be positively linked when profits are the reward to achieving significant internal economies of scale. Those scale economies, can you visualize the diagram? They bring down long-run unit costs, they bring down the average cost, they allow firms to bring their prices lower whilst making higher profits at the same time. However, profits are also linked to the market power enjoyed by a business. So when we have a monopoly or a duopoly or oligopoly, when market concentration is high, and especially when price elasticity of demand is low, then a business can raise and keep their prices well above marginal and average costs. Great for profits, but there is an associated loss of allocative efficiency and a loss of consumer welfare. The profits made by a business depend also on their objectives. So there might be a profit maximising business, or there might be a business happy to satisfy, or perhaps aim to maximise revenue or sales rather than go for profit max. And as we've just mentioned, many external factors also impact on profitability, and those factors are independent, essentially, of the degree of economic efficiency. So there we go. We've explored the extent to which profits and efficiency are linked. Hopefully that was a useful revision session for you. These are key terms, very, very important for your A-level and IB economics. Thanks for joining in. As always, we always appreciate you joining in. Take care, look after yourselves, and see you again sometime soon.